The Motley Fool just told 10 million people to invest their tax refund in VOO and SCHD. They're not wrong, but they left out the part that actually changes what you do with the money. The average American tax refund in 2026 is approximately $3,400, up 11% from last year, driven by new deductions from the Big Beautiful Bill Act. And the Motley Fool is right. VOO and SCHD are sound, proven instruments for long-term wealth. But the article has two specific gaps that change the blueprint for anyone serious about building income, and one of them affects you every single quarter if you buy SCHD. By the end of this video, you will understand exactly what the most read financial advice in America right now is missing, and you will have the complete blueprint that finishes it. The Motley Fool told you where to start. This is how you build on top of it. Before we go further, this video is built for anyone who has a tax refund in their account right now and wants to deploy it intelligently. It doesn't matter if you already own VOO or SCHD, or if you're starting from zero. What matters is that by the end of this video, you will understand exactly what the mainstream advice gets right, what it misses, and what the complete architecture looks like. Subscribe now, because this video is the first in the Tax Refund Blueprint series. Next Thursday, I am showing you the weekly income layer that takes the same dividend thesis SCHD is built on and converts it into payments that arrive every Friday instead of every quarter. Goldman Sachs built the instrument. The full blueprint drops Thursday. Subscribe so you don't miss it. Let's start where the Motley Fool starts, because they're right. VOO is the Vanguard S&P 500 ETF. It holds all 500 companies in the S&P 500 at market cap weighting, charges 0.03% per year, and over any 30-year period in its history has produced positive returns. Owning VOO is not a sophisticated strategy. It is a sound one. If you have zero investments today and you put your $3,400 tax refund into VOO and never touch it, you will likely be better off in 30 years than if you had done nothing. SCHD is the Schwab U.S. Dividend Equity ETF. It holds 100 companies, including Texas Instruments, Chevron, PepsiCo, and Coca-Cola, selected because they have paid and grown dividends for at least 10 consecutive years. Over approximately 50 years, dividend-paying stocks returned around 9.2% annually versus 4.3% for non-payers. That is, the Hartford Funds and Ned Davis Research finding. And it is a legitimate institutional study, not a marketing claim. SCHD has delivered 13% annualized since its 2011 inception. Year to date in 2026, it is up 16.5%. Trailing 12 months, 28.8%. Expense ratio, 0.06%. The Motley Fool's recommendation is not wrong. If you are a brand new investor with your first $3,400 and you need a simple, defensible, long-term plan, VOO and SCHD are a reasonable answer. The investomistic critique is not that the advice is incorrect, it is that the advice is incomplete. And the two gaps they left open affect every investor who follows it. Here is the first one. Here is what the Motley Fool article did not mention. The average 2026 tax refund is up approximately $350 from 2025. That increase is real. It comes from new deductions for tips, overtime, and senior citizens. But Stanford economists studying the Iran war's oil price impact estimate that the average American household will spend an additional $740 on gasoline this year alone, double the average refund increase. At $4.12 per gallon on tax day, the windfall many Americans expected has already been absorbed at the pump before they made a single investment decision. This does not mean you should not invest your tax refund. It means the Motley Fool's framing, for those who already have their emergency fund and debt covered, is doing more work than it appears. The article correctly says, shore up your emergency fund and pay down high-interest debt first. That is the right priority order. What it does not say is that for a meaningful percentage of refund recipients, rising living costs may mean those bases are not actually covered, even if they feel covered on April 15th. The honest blueprint starts with that question. Is this money genuinely investable, or is it already earmarked for costs that haven't arrived yet? Before we go any further, if your emergency fund is under $4,200, the threshold from an earlier Investor Mystic video, this money belongs there first. If you carry a credit card balance at 24% interest, paying it off is a guaranteed 24% return that no ETF can reliably match. The blueprint I'm about to show you is for the investor who has genuinely cleared those hurdles. If you haven't, bookmark this video. You will need this architecture in 30 days. So, before I show you where this money goes, I need to know where you are right now. Drop it in the comments. Building, if you are still working on the $4,200 emergency fund foundation. Deployed, if your foundation is solid and debt is clear. Invested, if you are already in the market and this refund is going straight to work. One word. I read every one, and your answer shapes which blueprint I build next. Here is the second thing the Motley Fool didn't say. SCHD pays dividends 4 times a year, quarterly. The last ex-dividend date was March 25th, 2026. The next one will be around June. That means if you buy SCHD today with your tax refund, your first payment arrives in approximately 3 months. And between each payment, the income you have already earned is sitting in the fund's distribution pool, not in your account, not compounding, not deployed. This is the quarterly trap. The quarterly trap is not a flaw in SCHD. It is simply how quarterly dividend ETFs are structured. The fund's total return accounts for those distributions regardless of when they are paid. But for an income investor who wants to put their capital to work actively, reinvesting distributions to build position, dollar cost averaging into the market, or simply having cash flow arrive more regularly, waiting 90 days for each payout creates an opportunity cost that the article never names. Here is the honest math. $3,462 in SCHD at a 3.26% yield generates approximately $113 per year in distributions, about $28 per quarter. The total return is the same whether paid quarterly or weekly. The frequency does not change the underlying yield. But here is what frequency does change. The number of times you make an active deployment decision with that income. 4 times a year means 4 opportunities to reinvest, dollar cost average, or redirect. 52 times a year means 52. That behavioral difference, not the math, is where the advantage of a weekly income system lives. SCHD is not the enemy of this blueprint. It is the foundation of it. The Motley Fool is right to recommend it as a core holding. But the income architecture that sits on top of SCHD The layer that converts quarterly patience into weekly momentum is the part they didn't include. And that is what we are building right now. The Motley Fool gave you Layer 1 and Layer 2. Here are the three they left out, and what each one does for your money every single week. Layer 1. $1,200 into VOO. This is your long-term market core, the S&P 500 at 0.03% cost. The Motley Fool is right about this layer. VOO is your 30-year foundation. You do not touch it. You do not trade it. You let it compound. Approximately 35% of the total allocation. Layer 2. $800 into SCHD. This is your dividend growth layer, the 50-year dividend outperformance thesis in a single fund at 0.06%. SCHD pays quarterly. You know that now. Accept the quarterly cadence for this layer because SCHD's total return, 28.8% over the past 12 months, 13% annualized since 2011, earns the patience. Approximately 23% of the allocation. Layer 3. $700 into week. This is your sovereign floor. U.S. Treasury bills distributing every Friday. At a 0.19% expense ratio and approximately 3.5% yield, this layer starts your weekly income cadence from the safest possible foundation. Your $700 generates roughly $1.19 every Friday before the market opens. Not life-changing, but it is the beginning of an architecture that is not in the Motley Fool article. Approximately 20% of the allocation. Layer 4. $562 into MMKT. This is your liquidity shield, a government money market ETF paying weekly at approximately 3.6%, uncorrelated to equity markets. If the S&P drops 20% tomorrow, MMKT does not move with it. It just keeps pinging your account every Friday. This is your emergency reserve, except it earns while it waits. Approximately 16% of the allocation. Optional Layer 5. $200 into XDTE. Only if layers 1 through 4 are established. XDTE uses 0 DTE covered call options on the S&P 500 to generate weekly income. Critical disclosure before you consider this. The most recent 19A1 notice from Roundhill confirms 100% of recent XDTE distributions are classified as return of capital, not income generated by the market, but your own money being returned. Evaluate XDTE on total return, not distribution yield. Expense ratio, 0.97%. Steep. It belongs at the edge of the architecture, not the foundation. $200 is a starter position, not a commitment. This is the complete blueprint the Motley Fool article pointed toward, but did not complete. VOO and SCHD for long-term core growth and dividend compounding, WEEK and MMKT for weekly income that arrives regardless of what equity markets are doing, XDTE as an optional satellite position for investors who understand the return of capital structure and want maximum cash flow. The Motley Fool told you the first two layers. The Investomistic blueprint tells you all 5.
Here is the honest risk map. No layer in this blueprint is risk-free. VOO has mega cap concentration and is negative year-to-date in 2026. It is a 30-year instrument, not a 1-year trade. SCHD's quarterly cadence is the gap we named. WEEK and MMKT are not FDIC insured. XDTE's 100% return of capital classification means the distribution yield is not income from the market. It is your own capital being returned, and you must evaluate it on total return alone. This blueprint is not a guarantee. It is an architecture. Know every layer before you deploy capital into it. Here is the tax psych reframe. Every April, hundreds of financial publications tell millions of Americans to invest their tax refund in index funds. That advice is not wrong. VOO and SCHD are sound. But sound advice without complete context is not a blueprint. It's a starting point. The Motley Fool told you where to start. The Investor Mystic blueprint tells you how to build on top of it. The difference between a person who puts $3,462 into VOO and calls it done, and a person who builds the complete 5-layer architecture is not intelligence. It is information. You now have the information. You now understand something that the majority of investors who read that article this morning do not. You understand what SCHD pays and when it pays it. You understand what the macro environment is doing to purchasing power before a single dollar reaches your brokerage account. And you understand that the architecture the mainstream financial press describes is a foundation, not a finished building. You have the blueprint. The pattern was here the whole time. Before the next blueprint, drop your status in the comments right now. Building. If you are still working on the $4,200 emergency fund. Deployed. If your foundation is solid and this refund is ready to work. Invested. If you are already in the market and you are adding the satellite layer. Your answer tells me which path I build next. And there are 3 different directions I can take depending on where this community lands. One word. Drop it now. Subscribe for Thursday's blueprint, because the instrument that solves the SCHD quarterly trap, the one that takes dividend thesis investing and converts it from 4 payments per year into monthly income with the NASDAQ 100 exposure, was built by Goldman Sachs. Since October 2023, it has outperformed every major competitor in its category on total return. Not distribution yield, total return. The ticker is on screen for 3 seconds right now. Then it is gone. The full blueprint drops Thursday. Subscribe so you catch it. This is Investor Mystic. Verified data, honest math, zero hype. The pattern was here the whole time.